Alright guys, this has been one of the most requested videos. So what is the investment criteria that I use to find the very best deals in property? Now for every property that I buy for my investors, there's 20 that I don't buy because they don't match my criteria. So in this video, I'm going to share what my criteria is by 4 main rules. So these are the 4 rules that if a property doesn't match, I won't touch that property. So stay tuned and you can thank me later. Alright, the first rule that a property has to meet before I even start looking at it is it has to be a freehold 2, 3 or 4 bedroom property. Now, I hope I don't have to explain this, but I want to own the entire property and the ground underneath it. Now, the reason why I don't buy leaseholds or flats is because you have higher costs. You have a ticking lease. They do not appreciate the same way that houses do. So the costs that are extra that you have to pay for a leasehold compared to a freehold is service charges and ground rent. And the real issue is that service charges, you actually can't control them. You know, that block managing agent can increase that charge to whatever they like. And the reality is that you can't negotiate with them. You know, they're picking the people that are going to maintain the building, such as the roof and the brickwork and the gardens and the communal areas and the lifts. And there's nothing you can do about it. If you don't like the service charge, you have to sell the property. The second reason is, why do I want a lease that is ticking down and that I have to renew and pay a cost to renew? So you have to pay solicitors to renew a lease, and that is just an extra added expense that I don't want. And the third reason is that leaseholds do not appreciate the same way that freeholds do. This is just a statistic. If you look at the data over the last 1,000 years, which is how long we have stored data for UK properties, properties that are freeholds have always outperformed properties that are leaseholds. One other thing to consider here is the type of tenant that a freehold attracts compared to a leasehold. So a leasehold, a flat, usually attracts shorter term tenants, people that will be there for a year or 2 years, maybe even 6 months. And obviously, when that tenant leaves, that property is going to be vacant and it's not going to be generating any cash flow. Also, you're going to have to pay the council tax and the gas, the electric, the water, whilst that property is empty. Also, you're most likely going to have to do a little bit of maintenance on that property to sprucing it up and attract the right tenant types again. And obviously these are all just added extra expenses. Whereas when you look at a freehold, the property is most likely going to a long-term tenant, a young couple or a young family, a bigger family if it's a 4-bedroom property, and these guys will be looking to stay there for 2, 3, 4, 5 years. Now, I've had some tenants that have been in properties for 10 years. So obviously that means more consistent cash flow, no vacant periods, no liability in terms of utilities, and very, very little maintenance because the people that are staying there are treating the property as their long-term home because it is their long-term home, and so they're going to look after it a little bit more. Now that's why I only buy freehold properties, and I recommend you do the same. Now if you're in an area where you can't afford a freehold property and so you have to go for a leasehold, for example in London, maybe start looking at other investment areas where you are going to get more for your money. Which leads me on to point number 2, which is prime investment area and regeneration. Now, the second most important thing when it comes to the criteria of a property is the investment area. Now, this is so important that if you buy a property in the wrong area, it can completely destroy your investment. So it's very important to make sure that you do your research and pick a prime investment area. Now, what does a prime investment area actually look like? So first and foremost, you need to be looking at rental demand. That property is being bought for the purpose of being rented out. So if there's no renters demanding that property, then your property is going to sit vacant and it's going to cost you money. And instead of it being an asset, it's actually going to be a liability. Now, another thing that rental demand means is rent increases over the long term. If there's a lot of people looking to rent that property, every time you renew that tenancy and you put a new tenant in there, you can now look at the new market value of the rent and then increase your rent accordingly. Whereas if you invest in an area where there's very low rental demand, you're not going to be able to do as steady rent increases over the long term. So another thing to consider when looking at the investment area is the regeneration and the local infrastructure that's being built around that area. So this one's the the actual secret when it comes to beating the average national growth rate is you want to be investing around regeneration projects, which will help inflate your rental demand and your property's value over the long term. So for example, in Leeds, we invest around the South Bank development, which is a £500 million regeneration project, which is literally doubling the size of the city centre. And we invest literally 10 or 15 minutes away by car. Now, the third rule for a property that I will touch is it has to be an established property. Now, what I mean by this is I will never buy off plan as an investment. I want to be able to look at a property. I want to be able to go see it and touch it and evaluate it and look at the roof and look at the joinery and look at the doors and look at the windows. And I want to be able to see what I'm buying. I don't want to invest into hopes and dreams. Now, I've heard so many stories about developers promising the world to investors, taking their money, and then delivering a pile of rubbish. Or even worse, a pile of rubbish that is 5 years behind schedule. When I buy a property and I buy it and it's established, I know what I'm going to be able to rent that property for. I know what I'm going to have to spend to renovate it. I know what the area is like, what the area is going to be like, and I don't want to play the guessing game with my hard-earned money. Okay, the fourth criteria that I look for investments is a yield of around 7 or 8%. Now, this is the minimum that I've set out, and yes, I could get more than that if I wanted to, but I have picked 7 and 8% because that gives me access to high growth areas at the same time. Now, my main goal is compounding long-term growth, so I'm happy to take a yield of 1 or 2% less to ensure that I get that growth rate long-term. But it is very important to me that I do make a monthly income on all the properties that I source, because it allows my investors to, have that buffer whereby if for 1 month they have a vacant property or they have an extra bill or their interest rate goes up when they want to refinance that property, they have that buffer and they're never having to pay out of their own pocket to hold on to that property. So I make sure that the rent covers all the costs plus a little bit for a rainy day. So if the yield is less than 7%, I'm not interested because it doesn't give me a big enough buffer. And if it's above 8%, I will look at it, but I will question the area and the growth rate, and I'll make sure that it actually has that growth rate that I'm looking for, because that's the main reason why we invest in property. It's for the long-term growth. And the properties that usually yield higher than 8%, they don't actually appreciate long-term because they're not in the best investment areas. The best investment areas have already had a little bit of growth and they're expected to continue growing. Whereas if you go for properties that are still very cheap, hence why the gross yield is very high, then most likely that is going to continue the case. So these are the 4 things that I look for in an investment deal before I actually make an offer on the property. So let's run through them once more. So number 1 is a 2, 3 or 4 bedroom freehold property, no leaseholds, and I want to attract long-term tenants. So number 2 is prime investment area, which means strong rental demand and regeneration in that area. Remember, you want to be invested in the deal whilst that change happens and whilst the area is being improved, not afterwards, not whilst the property's already gone through the change and the regeneration's already happened and the area is actually a really nice area. You want to be buying in an area that's getting better and you want to be invested in that deal whilst that change happens. Number 3 is an established property. Don't buy off plan. I don't like to buy hopes and dreams. I want to be able to go look at the property. I want to evaluate the property and I want to know exactly what I'm buying from day one. So number 4 is a gross yield between 7 and 8%. So remember, anything below that and I'm not making enough money on a monthly basis to cover me just in case my costs go up. And anything above that, then you need to have question marks and think, why is the rental return so high? Maybe it's because the property is so cheap, and the reason why it's so cheap is because it's not had any growth, and that is maybe going to continue whilst you own that property. So if you've made it to the end of the video and you're enjoying these videos and you have £50,000 or more and you're looking to find a team to help you build your portfolio, make sure you press the link in the bottom of this video to go to my website and put your details in there. We'll then have a chat to see if we're a right fit. If you're not in the best investment area, you don't have the time, you don't have the expertise, you don't have the network, then maybe we are. And if you do have these things, then maybe we're not, but we'll never know until we have the conversation. So press the link at the bottom of this video to go to my website. All right, guys, we'll see you on the next one.